Hello, everybody, and welcome to our webinar, Timely Capital Moves, Avoiding Costly Mistakes Before Your Next Raise. I'm going to give folks a few minutes to join the room before we actually kick off the presentation, but just some scene setting for our session today. We really want this to be an interactive session, and we really want it to be a session where you walk away with action items, so don't be shy. That's all I'm saying here. We have a lot of content planned. I'll walk you through a detailed agenda, and we'll make sure we cover a lot of things, but raise your hand. I'm going to be keeping my eye on the chat and the Q&A to make sure that everyone gets heard. But I'll be repeating this housekeeping in just a couple of minutes once we get the full quota here. So thank you so much for joining us today.
Where's everyone from? Where's everyone located?
Yeah.
Can I guess maybe drop it in the chat.
Oh, I know that I'm here in Vancouver, but I'm originally our Boston guy. So I flew across the continent to come meet with my team today, and we're very excited to all most of us be in the same time zone for once. It's very rare that we get to do that, but that's part of the strength of what makes Boast so great. And again, our partnerships across the continent. All right, Suji, you're in Canada.
I'm coming too.
Best place to be, in my opinion. I'm a little biased, but I kind of like Canada.
Awesome. Water. Okay, I will be giving it one more minute. And then we will kick things off. If you hear a voice in the background, it is my CFO Keith in the office next to me taking a call. I apologize if that's distracting, but one team, 100. All right, folks. Without further ado, I think we can probably start things off. And again, you'll all be getting a copy of this recording after the fact, and we'll be able to give this to anybody who maybe didn't make this call but is in your network who would get value from what we're covering today, especially about, again, just making sure that you're capitalizing on the opportunities in a timely manner. So, like I had mentioned, we have a very detailed agenda for you today, but we're going to be flexible here. We want to make sure we're covering all of our bases and answering your specific questions. For the third time, keep it active in the Q&A. If there's anything we didn't cover, if there's anything we left off the table, we want to make sure we dive into it. But we're going to kick things off with a little bit of a Shred 101, just give an overview about the program to date and about proposed changes to the program. Then we're going to dive into the hidden costs of losing refundable Shred and just how you can structure to make sure that your program is building your products isn't leaving cash that you're entitled to on the table. Then we're going to talk about understanding CCPC status. So that is Canadian controlled private corporations and Shred eligibility to make sure that you are getting the maximum refund possible with the structure of your business. Then we're going to go into mitigation strategies and best practices. We're going to talk through a few case studies, give you some actionable tips on how to maximize any claim, and then again, action items and next steps, which will be variable based on your input. So be active in the Q&A. Okay. So to kick things off, I'm just going to give a little bit of a primer about Boast. What we do is we specialize in helping organizations claim and access eligible R&D tax credits, minimizing audit risk and time-consuming processes in both Canada and the United States. So we combine in-house technical and R&D tax expertise. So again, we can speak that language that your product team is talking, and we can also speak to the CRA or the IRS, depending on where you are located. And we mix that with the latest AI technology to actually make this an effortless process. So we take the heavy lifting off your shoulders to make sure that you're maximizing your access to the claims that you deserve and you're entitled to. So since Boast's founding in 2011, we've helped more than 1,600 businesses across North America tap into more than $625 million in innovation capital to build stronger products, extend their runway, and drive world-changing innovation. So our experts today are Matt Rodeshauser and Carlos Coelho. And I'm going to kick it over to Matt to give a quick hello.
Okay, so yeah, my name's Matt. I've been in Shred at Boast for almost a decade now, 8 years. I'm also a recovering software developer. I used to work in the software industry, and I'm keeping abreast with everything going on there. Carlos?
Thank you, Matt. Welcome, everyone. Carlos. I lead the sales team here at Boast. I've been here for almost 5 years. The Shred program to me is one of the most exciting things there is in any of the innovation and incentive programs in Canada. So I'm very excited to share a little more of what's possible with the Shred program and what's yet to come very, very soon, actually. I'd love to answer questions you guys may have. We have some questions for the audience as well. Paul will share more of that shortly, but would love to hear from you guys as anything comes up, anything we talk about or sounds interesting and you're curious to learn more, please say so. This is the reason why we're here, to help educate folks like you guys.
So now I'm going to pass it off to Camellia, who is on the Smythe team, to give a rundown on Smythe and also Emily and herself. So Camellia, over to you.
Great. Hi, everyone. I'm Camellia. I'm a partner here at Smythe, and I lead our technology industry group. We are an accounting and business advisory firm based in Vancouver, and we help companies grow and help them navigate the challenges that come with that, including market expansion, exit planning, tax optimization, including optimizing tax credit incentives like Shred. I'll pass it over to my colleague, Emily, now.
Hi, I'm Emily. I'm a tax principal in our Canadian tax group. We work with a variety of companies and structures and a lot of technology companies as well, both in Shred and other tax considerations.
Awesome. Thank you so much, Emily and Camellia. So before we dive into the meat of the actual webinar that we're all here today, I'd like to poll the audience just to understand specifically where you're at in your growth journey and how we can make this the most valuable possible webinar and workshop for your needs. So I'm going to leave this on the screen for a couple seconds, and I invite you all to dive into this QR code, use the URL, and then join our quick poll. So you'll notice that there are 5 questions, but we're really focused on the first 3. So that's what I'm going to walk us through before I switch back to the webinar. So I'm going to give it about 30 seconds for folks to actually join the poll. And I see some responses coming through. And now I am going to stop my share for a moment and just instead share now the poll results. Okay, so our first question is, what fundraising stage are you at? Basically, where are you at in growing your business and getting the actual funding you need to drive the innovation that you are really seeking? For some context, this is extremely valuable for capitalizing on those R&D tax credits, just because when you hit different thresholds of your fundraising journey, the opportunities evolve, and there's different strategies you can use to actually maximize those, whether it's stacking or whether it's tapping into grants versus Shred or R&D tax credits at the provincial level or the federal level. We'd love to know, just from everyone in the room, roughly where we're at. All right, so it seems like we got a Series A audience, but we fully run the gamut. We got some pre-seed here, we got some exit here. So I think it was just a broad swath look at the programs and the opportunities is what we'll focus on for today. I'm going to go over to the next question. What is the residency of your investors? Wonderful. So it looks like we have a primarily Canadian investment population here. That's definitely going to simplify a lot of the commentary that we have here about your eligibility and your statuses. All right, knowing that this is roughly the cap at where we're at with the poll, how familiar are you with Shred? Claiming. Okay, so folks here know the program. They are claiming, but maybe they would like to learn how they can really maximize that claim, but also evolve their strategies to tap into a wide swath of funding opportunities. So I think this is fantastic level setting. So I'm going to stop the share again. And I'm going to switch back over to the actual run of show. And now, Carlos, I would love to pass it off to you to kind of just give some grounding around Shred. So as we just learned, folks here are by and large all claiming, but a bit of the historic context of why Shred, what we got here, the true value of the program, and then we'll look to the future.
For sure. No, thank you. This is great. I love when folks are already claiming Shred, they're considering Shred, they know what the Shred is, and they've gone through the process. This is great. I always celebrate those that have done that. It is, like I said at the beginning, largest program in Canada, $4 billion given out every year. We're moving, 22,000 companies are claiming latest numbers we have from the CRA, which is roughly 200K average that these companies would get back from the government, right? And it's so many industries that they have claimed Shred. We have, folks working with us. They have breweries in the fashion industry, obviously hardware and software, but so many other unique industries. We'll talk more a little bit later about what does it mean to be eligible for Shred. Who is that? Who is actually someone that can potentially claim Shred? Mainly in Canada. If you've claimed before, you know this also by heart. CCPCs and non-CCPCs are allowed to claim Shred. Details are on the left. The closer you are to pay more taxes, having full-time employment is the situation where you get more money back. Well, up to 70% in Quebec, 64 BC, 62 in Ontario. So it is a good amount of money that you can collect back from the government by doing unique work. Since most of you guys have in this call have claimed or considered claiming, I'm not going to spend too much time going to the nitty gritty. I think it's important to go through not only where the program is today, but where it's going to go next. The program has been in place for over 60 years, since the 40s and 50s, and it evolved to where it is today. There's some changes coming up, things that the government considers and celebrates as part of the program is basic research. Whenever research is applied, and then whenever there's scientific development and expansion. So I would love to share a little more about the future. So there is an announcement coming up with the new budget. The government is announcing on the 4th, November 4th. And in December last year, they announced some of the proposed changes for the Shred program. This is after a lot of consideration, a lot of requests from the startup community about changes. And these are some of those that are being considered. There's a period of time where they opened up for feedback on some of these changes, and we actually provided ourselves feedback to what these changes would look like and what this could mean for companies across many industries. So right now, what is being proposed and potentially approved by on November 4th updates is an enhanced credit limit from 3 million to 4.5, which is fantastic. Today, there's a limit on that. Capital expenditures are back. So folks can now potentially submit expenditures like manufacturing, like machinery, potentially, if you have a location that you're renting, things that are very specific to your industry, to your work. And a lot of the companies that we work with do have machinery, and we're never able to apply because of these things are not included. They were included back in 2014. There was a change in the program, and for 10 years they were not included. For Canadian public companies as well, now they could potentially claim back again, like eligibility is back on the table for public companies. And lastly, I'll talk about the taxable capital, so higher phase out threshold. So going from, we can go into specifics later for you guys want, but from 10 to 15 million, 50 to 75, which opens up the door for innovation. So allowing, covering not only inflation, but also the changes in the market that have been happening in the last 5-6 years. So we'll talk more about the details of that. We're very excited to see what will come out of the new budget in about 2 weeks. So everybody's glued to the screen to see when that comes out.
Yeah. So Carlos and Matt, Boast team again. So fundamentally, at the core of what Shred delivers, more or less this question. Matt, do you want to maybe speak to this and some of the qualifying criteria? And again, knowing that everyone in this room is actually by and large familiar with the program, to some of the nuances, even about why the changes have been made and that are being pitched right now. related to the capital expenditures, the higher phase out threshold, all the above.
Yeah, happy to. So at the core idea behind the SR&ED program is that if a company is taking on technological risk, the government, the CRA, is there to help you take on that technological risk. So really, if you know you're going to succeed with your technology, there's not really any risk there. But if you don't know whether your technology will work out, whether you'll be able to pull it together, there's technological risk or technological uncertainty, like the CRA likes to call it. And so really what this can look like, I'm going to use AI LLMs because that's what's hot and popular these days. And we all know that despite the long ways that LLMs have come from the early days in 2023, they can still hallucinate. And sometimes you need to have them in a situation where they're hallucination free. So are you able to somehow bridge that gap, reduce the hallucinations? Or another potential uncertainty with LLMs is, hey, it can take half a minute for an LLM to respond, depending on what you ask it. But maybe you need to get the answer back in a sub-second time frame. How do you deal with that? Can you make that work? So those are some examples of these uncertainties and how that enables you to have SR&ED. Yeah.
I think you put that perfectly, Matt. And again, it explains also why they want to enhance the program perfectly. They want to make sure that they're helping you take those risks so that Canada can continue to be on the cutting edge. I could go for hours about LLMs and AI of it all, Matt. So that'll be our next show because I think there's so much to unpack there. And that's a big focus of the Canadian government too. So that is fantastic grounding, I think, for us. But it also takes us into the next point, which I'd love to tat over to Camellia to unpack for us. Hidden cost of leaving refundable SR&ED. So refundable SR&ED, key term there. Camellia, unpack this slide and what we're talking about when we say compounding effect, admin complexity, all the above.
Yeah. So why does this all matter? Well, SR&ED represents the single largest source of non-dilutive funding for Canadian innovators. But beyond just losing the cash, what are the other implications of losing your refundable status? Well, there's a compounding effect. Once you lose your CCPC status, your Canadian controlled, you're no longer a Canadian controlled private corporation. Future claims are non-refundable and you can't retroactively fix it. So not being able to rely on that cash slows growth. It may prevent you from entering a new market, hiring key talent, impacts the pace at which you innovate. And in this fast changing world where time to market, speed at which you scale matters, companies just can't replacing capital. So when refundable credits disappear and you can't rely on that cash, your runway shortens. And if you're not profitable, every dollar of lost SR&ED is a dollar you need to replace with investor capital, and perhaps not on the most ideal of terms. So if it's debt, you potentially have higher interest costs, another drag on, resources. If it's equity, you're getting diluted. And either way, fundraising is not easy. It takes time, founder time, to do the fundraising dance with potential investors, dealing with your advisors, working out deal terms, going through due diligence. That doesn't always result in cash in the bank. But even if you are successful in raising capital, when you have these additional creditors, shareholders, you have more parties that you need to be accountable to. So again, a little bit more rigor around the structure of your company that could slow you down. Investor management takes away time that likely could have been better spent on strategy and just business. All that being said, we're not saying that raising capital is bad. There is certainly a lot of smart strategic money out there. Just don't do it because you've lost access to your refundable SR&ED. All right, so administrative, structural complexity and implications on valuation. As appealing as it is, we're not advising to preserve refundable SR&ED at all costs. We've seen companies get creative and go to great lengths to preserve their CCPC status. But complicated structures come with administrative costs and increased risk. So they demand time, fees, internal bandwidth, a drain on your resources that could have been, used just working on the business. Complicated structures also have a direct impact on investor appeal and valuation. So we've seen deals stall or valuations discounted when buyers discover aggressive CCPC positions, convoluted cap tables. We've seen cap tables with everything, options, convertible notes, safes, preferreds, all with different terms. Not only is it expensive to maintain, it's hard to interpret who ultimately controls the company, and hence, are you a CCPC or not? Because that impacts your refundable status, also a whole host of other great Canadian tax incentives. Again, even with all this, there are legitimate reasons to become a non-CCPC. So, for example, preparing for a U.S. acquisition, but the decision just needs to be intentional, deliberate. Sometimes it's smarter just to maintain a simpler non-CCPC structure if the end goal is to exit to a foreign buyer. If it makes for a smoother and quicker close, the valuation's right, that can absolutely be the right move. Okay. And with that,
I was going to say, Camellia, if this were one of our podcasts, be intentional would be probably the name of the episode, because I think that's a huge takeaway that we really want to emphasize here. And I think that tees up Emily very well to dive into how you can be intentional, specifically around the structuring of your company and that CCP status that you keep alluding to. So, Emily, take it away. If you could tell us about, again, CCP status and SR&ED and how you can be intentional to make sure you're doing what's best for your business and also making sure you capitalize on the non-dilutive funding that's out there for you.
Right. So yeah, we're wanting to set you up to make informed decisions. So I'm going to break down the technical foundation, what it means to be a CCPC, as this is traditionally the gateway to enhanced SR&ED benefits. As Carlos alluded to earlier, they are opening it up to Canadian-controlled public companies as well. I'm going to focus on the CCPCs. A lot of the considerations around a control are going to apply to both, though. So as a side note, it's important to note that other tax benefits, such as lifetime capital gains exemption, the small business deduction, favorable tax rules for employee stock options, all of these also rely on CCPC status and can be very important to growing businesses. So CCPC means Canadian-controlled private corporation. Somewhat counterintuitively, this focuses less on control by Canadians and more on whether non-resident or public companies that aren't Canadian controlled as a group either have the ability to control the company or have the right to acquire the ability to control the company. So this isn't just about voting rights and ability to elect the board of directors, which is what we traditionally think of. It also includes contractual rights to acquire control, such as shareholder agreements, option and convertible debt rights, signed agreements granting the legal right to purchase shares in the future. All of these can impact your status, and you want to be intentional. You want to know what you're getting in for when you do it. Because from a SR&ED perspective, losing CCPC status means that your enhanced refundable rate drops from 35% federally down to 15% non-refundable. For a company that's growing, doesn't have revenue, doesn't have taxes owing, not having refundable SR&ED credits, it can lose a lot of the value that you're getting from the company. So I'll pass this back to Paul, unless we have any questions on this point.
No, I think this is fantastic, and I think you actually laid the scene very well for this next stride about just mitigation strategies. And again, when we're saying mitigation too, it's not necessarily, again, about structuring your company to make sure that you're getting those tax credits. You do want to do what's best for business, but at different phases of your growth, you want to take different approaches. So I'd like to turn this into a little bit of a roundtable, but I'm going to kick off with Matt and Carlos on our team. Matt, if you could maybe talk about some high level before fundraising, during fundraising, after closing. Let's start at the beginning maybe, and just what are some tips and strategies that you would recommend for folks in this room? Knowing that, again, these are folks who are claiming SR&ED today, but
Yep. Yeah, no, I think even though they might be claiming SR&ED, they're investors, or even if you're looking to exit, the companies you're talking to or people you're talking to about acquiring, getting them up to speed on the value of shred. It can help impact your valuation, and it can help make the company more attractive the more they understand that it's a matter of really transparency, being clear on the whole thing. And I would actually say that goes throughout the whole piece. Is you just don't want to have any surprises. You don't want something to come up and be like, oh shoot, if only I had known that. And so it's take the time to look into it, take the time to talk to someone who knows about your company structure, who knows about valuations, who knows about shred and all of that, and move forward with that. That would be my biggest thing.
I
I
love
would,
it.
I would agree with that, especially because there are situations where, I think we're going to talk about this a little bit later, where there's scenarios when you do fundraise, there might be scenarios that might trigger a potential loss of shred. That might put you in a situation of risk for shred, and shred is very important for a lot of companies. Some of them scale because of it, and so, as Matt alluded to, many times we hear folks coming, having done one or two claims before they fundraise, and tell us how important it was to have had that one claim or two in their back pocket, and a stamp from the CRA saying their work was innovative, to then leverage that to say, look, and it's not just me saying it, the CRA, validating our work is innovative enough so that they give us this refund. So there is value in not just the monetary amount that you get back, but also the stamp from the CRA and the support they get from doing so. So yeah, that's what I would say, mainly for before and then during fundraising. Yeah.
Love it. And then Smythe team, I'd love for your insights too. Maybe we can even talk about further down in the process. I know we focus a lot about the pre-fundraising, but looking at this whole scenario, what are some initial thoughts that you'd like to drop in here?
I can jump in on this one. I would say just having a team that you're working with that is aware of these issues and can look out to them for you. There's a lot to know. And my ask would be, hey, let your advisors know. Let your advisors keep them in touch with substantial changes that you're making, new investors that you're bringing on, and make sure they're weighing in, on beforehand rather than trying to deal with issues that have arisen afterwards.
Oh, well, right. And Camellia, any other notes to add in here too? I know even just the eligibility monitoring and everything that's involved in terms of just making sure that you're up to date with it all. What are some
Yeah.
strategies or tips? Yeah.
Yeah, and I would say, throughout this whole process, just alignment with leadership, like internal leadership is important. So not only, educating your potential investors, but also governance as well. Help leadership understand the value of the shred benefits, walk them through scenario modeling, the structure so they understand. And this can help them make informed decisions as to how to raise capital, how to, go into a transaction and organize the company's operations. I also find that, key members of management don't understand the broader implications of raising capital, both, administratively on exit. So I think this is a key component of alignment just to ensure success.
I love that. It calls back to the whole being intentional, but also just be transparent and make sure that everybody is on the same page about what the best course of action is going to be. And you're not leaving any stones unturned in terms of your stakeholders. Make sure everybody's along for the ride with you. I think that's fantastic. All right. So just to kind of level set, knowing that we're at the half-hour mark too, we're going to go into some case studies specifically around fundraising examples. And then I'm also going to turn it back to our polling questions just to understand where folks in the room are putting their investments. But before we get there, I'm going to do another quick roundtable chat about these different scenarios that we have outlined here. So for case study 1, a Series A board structure lost $800K annually. Who wants to take it?
I can take that one. So this is an example we had not too long ago. Company was raising, I believe it was $5 million at the time, Series A, and it was a U.S. investor And so that change of the fact that it was a U.S. investor and the way the board was determined, it was set up, it would trigger the non-resident status on that account, which would prevent them from getting a shred claim. So they lost close to $800K on the potential shred claim that they would have gotten if they had prevention. Then the prevention of looking inside and discussing what is the best alternative for their board structure to be, considering the fact that they had a U.S. investor, so that they would maintain the ownership in the Canadian hands, so they could apply for the shred program. So it's a very very delicate matter to be considered. If you are in a situation where you have a large R&D team, and shred is a big deal, as a big part of your budget every year, you should consider that very carefully. And if you obviously foresee that you're going to continue to be claiming, do not, think about that lightly. It's a big piece of a part of how you set up your company. And folks like Smythe can definitely help you guys understand what's the best approach there.
Absolutely. So before we move on to the next case study, I do have a general question from an anonymous attendee. But general question, what is the most advantageous way to account for the main shareholders, so greater than 50%, compensation to maximize our shred claim? Pay wages as an employee, pay him as a subcontractor, or any other thoughts?
So a really great question. I'll jump in on this one. And there's the business decisions aside, from a shred perspective, there's a very clear answer. You do want to be paying them as a salary. There are rules around specified employees, and there's maximums that you can claim. It's tied to the YMPE, but there's a lot of room there. Another key consideration is it has to be monthly salary amount to count for shred. If you've got your specified employee, which anyone over 10% is going to be, if it's a bonus or in any way tied to remuneration based on profit, it's not going to be eligible for shred. And so if you're going to pay them anyways, let's set you up to make sure that you can get this shred claim back.
And I just want to throw out there, paying them as a contractor, they'll be a non-arm's length contractors, and that will not be eligible for shred either. So just to clarify, you want T4, not T4A. You know what? Since I'm talking, I'll take the next case study here.
Sure.
So this is one where the company started out in Canada. They were doing well, and they decided they wanted to tap into the US market, expand into the US. So the CEO, she owned 51% of the company at that stage. She moved to the US and she became a US tax resident, which meant that they didn't realize this at the time, but they lost CCPC status. Then when it came tax time, they looked into that and they realized, oh shoot, we're no longer CCPC. And one of the things it impacted was their shred, which they had kind of been counting on. And so they had to scramble to backfill all that capital. And then what they also did is they realized if they had just moved 2% of the shares from her to her co-founder who stayed in Canada, they would have remained CCPC. So it was a small fix, and they did it the moment they realized it. But that meant there was still those 8 months where they more or less lost their shred. And so that's just one thing where just a little bit of, it was one of those surprises I was talking about earlier.
Yeah, I think that's also, it goes back to, again, the unexpected things that can happen when you're not being very intentional. Again, theme of the time. Camellia, that's my cue to get your take on case number 3. So signed SPA, lost CCPC status. Could you unpack that one for us?
Yeah, so another situation of mitigating surprises, but being aware of the implications on shred when you sign a share purchase agreement. So oftentimes a Canadian company signs a SPA with a non-resident acquirer. Very common, almost 80-90% of the deals that we've seen have been to a non-resident acquirer, but it wasn't a sign and close on the same day. That would have been straightforward. It was a delayed close. sometimes a few weeks, it can be a few months. This is also very common. But the date of signing of the SPA triggered the loss of CCPC status due to the non-resident having the right to acquire control. So the target was not eligible for refundable shred. There was a perfectly good reason for entering in this transaction. Obviously, selling shares, right acquire, right timing, right valuation, but it does have reporting and cash flow implications. And if you're counting on that shred until close, that's a surprise. So more of an avoidable surprise than a deal breaker in this case. I would say this also extends to certain LOIs as well. I'm not saying every time you go out and sign an LOI, you're going to lose CCPC status, but just be aware of the terms when you sign your LOI, because that could trigger the loss of CCPC status as well. So involve your deal team early, mitigate surprises, and plan accordingly.
Beautiful. Okay, Emily, I'd love if you could help us out with case study number 4, aggressive CCPC claim due diligence review.
Yeah, I'll jump to the flip side of it. So we also help companies during their due diligence process. And one thing that we've seen before is companies that have been very aggressive with maintaining their CCPC status. They've taken filing positions that are deeply in the gray area. And this gets flagged as a concern to prevent potential acquirers. Like if they've been getting hundreds of thousands of dollars in shred refunds for years, during years in which there could be a challenge to whether or not they were a CCPC status, CCPC, it did cause pause to the inquirer, and like there were specific terms that were negotiated during the purchase that was looking at this and the risk of a CRA review. So I think this again ties back to being intentional. If you know that your goal is to exit and to be an attractive target to a purchaser, you'll want to keep these kinds of things in mind. What is the long-term impact of the decisions that you're making?
I think that makes perfect sense. Now, before we dive into the next slide, which is going to dive into maximizing your shred claim, I'm going to pull it back to the poll like we discussed. So I'm going to stop my share for a moment. Okay, so we talked about how familiar you are with shred, but I would like to now know, where are you actually spending on all of this? Which type of R&D expenditures has your company actually incurred? So it looks like we got personnel costs for algorithm development is running theme here, custom software development services, cloud computing and infrastructure for R&D. Okay, so this aligns very closely with what we see from our customer base, which is that software development, that classic e-business kind of model. This is great. Any thoughts on this feedback that we've gotten so far from the room, or before we dive into the next one?
I did want to just throw out there that on the chat, Sujit has also asked, how does this stuff apply if you've got a joint venture in the United States? And so just a few quick thoughts off the hop there for me. Sorry, I know I'm going off on a tangent here, but a few quick thoughts off the hop are that the US R&D tax credit, you can claim that as well. It's not nearly as lucrative as shred. Generally, most companies in the US rely on the venture capital down there and all of that. And then, as we've already kind of intoned, be aware of where your tax residency is. If you are a controlling, if you're the controlling owner of the company, or you're part of that group, because that might have implications on how much shred you get back. So that's just the two things I would toss out there.
Absolutely, Matt. I think that's critical. And yeah, again, as the American on the call here, I have a lot of thoughts about comparing the R&D tax credit program, the Section 41 of it all, to Canadian shred. So we'll save that for the next webinar, but there's so many nuances there. And even just in terms of what the priorities are for the different programs, they're not at odds or in competition with each other, but they're framed differently in subtle ways that you should bear in mind, because you might be doing work that would be relevant to both programs, but it's just about framing it in the best way.
Yep.
So just to give Boast another shout out there, we're experts at that. We know the cross-border opportunity. We also know, again, it's not that you have to be doing a different kind of R&D to get the tax credits in the United States, but you just have to frame it in the language that the IRS speaks versus the CRA, for instance. So won't go any deeper on that tangent, but Matt, I'm very happy you raised that point. All right. And then this last one is very similar, but again, just like, where is your company spending on technological development? It looks like right now, which is good to see, in-house software developers working on proprietary algorithms. Again, that aligns with what we see with our client base. Also, cloud computing resources for R&D activities. I think that this is, again, 80% roughly of SR&ED claimants are software companies in our experience. And I think that's going to evolve, but it's just going to evolve with the tech evolution in general. So how you characterize a software company versus an AI company, for instance, down the line, that's going to become a point that's going to be a lot more considered. So any other thoughts on this poll and the answers here, seeing how weighted it is to in-house software developers before we move on to some of the strategies?
Well, I do want to mention that generally cloud computing resources are not usually claimed directly in the SR&ED program. They are claimed directly in US R&D tax. So just for the person who put that outlier, if that is the same people who are in have a joint venture in the United States, it's just some considerations there of where you're routing those costs.
It's a great point, Matt. Yeah, and it ties back to my ramble a few minutes ago, where it's just really, it's about making sure that you're, again, just framing the work that you're already doing, not doing work above and beyond the work. You think that it's a different qualification criteria. It's a lot of just getting that narrative nailed. So I'll stop digressing there, and we're going to get back to the strategy of it all. So switching back to our slide deck. Just a moment. All right, so we walked through these case studies. Maximizing any claims. So again, this is broad strokes. Really, really want to emphasize here that what we're recommending here also is not to structure your business in a way that's going to maximize your access to tax credits. Do what's best for your business. That goes back to the conversation that the Smythe team here was having about the CCPC structuring and making sure that you're doing it in a way that's actually going to drive the best outcomes at the end of the day, not just the maximum access to R&D tax credits. But if you're looking to get SR&ED, these are some tips that we've seen, and I love for the Boast team to maybe dive in a little bit here. Carlos, do you want to kick off some of these points?
Yeah, for sure. Like think of, like I said at the very beginning, if you have folks that you're paying salary, direct salary, full-time employment, higher chances of you getting more money back. And so consider where those folks are actually located, what province they're going to be located, right? Make sure you have an office there as well. We have clients who have offices in different provinces, and they can claim the regional province or the provincial SR&ED because of that. So consider that, because that could have an impact. Some provinces pay more, some provinces have better returns, and sometimes the labor is very similar. So think about that. And I guess, make sure those that are doing R&D work that are in the tech roles, make sure you pay them salaries, right? Sometimes we hear situations where they're getting equity or they're, waiting until they are able to raise or sell something to then start paying themselves. And it's tough because the government wants to see that you took risk. And by that means you took money out of your own pocket to test and to try to solve a problem you saw out there in the world. So if they don't see that, right, then that's a problem. They can't validate that you could have a claim or money to receive back or a refund to get if you haven't spent anything at that point in time. So very important to do so. And obviously make sure they're, if they're in a province in Canada, that they are physically located in Canada. They're not outside of the country doing work for you, because that would not, be allowed as part of the SR&ED program. They want to make sure folks that are making money here are also spending it here, collaborating with the economy, making the economy grow. That's really the whole purpose of it. Matt, do you want to tackle the Canadian contractors as well? I think it's a good one.
Yeah, I'm happy to do that. And I guess one of the things is if you outsource outside of the country, the Canadian government says, well, we're not seeing those tax dollars anymore, so we're not going to be able to funnel them back through SR&ED. But the other piece there is even if the company you hire is a Canadian company, but they are then passing the work off to non-Canadian residents, the CRA has a look-through rule which says it's the person who's getting paid at the end for doing the work that matters, not the company in front. So they look all the way through and would say that isn't eligible for SR&ED. So just an asterisk there on that. The other thing I wanted to bring up is, and this is partly again because of a comment in the chat where it says we also did specialized hardware and testing equipment. So there's so with the new capital rules, there's that may come in, but also if you are actually having a tangible physical material that you're using up in your SR&ED pursuit, there's a very good chance that you can actually claim that. And I'm saying a very good chance because it depends on how you frame your SR&ED claim in that case. So I'm happy to talk all about the nitty-gritty, but I'm not happy to make this webinar take another 3 hours. So I'm gonna leave it at that. But we could delve more into that if you want follow-up.
Absolutely. And Fuji, I'm going to recommend that you connect with Matt after this call because it sounds like you guys could talk shop for a little bit. And I want the notes. So that is fantastic. Okay, we're going to move on to the next slide, which is about your action plan. And this is another one that I kind of want to roundtable. I know we do have specific talking points here, but Camellia, I'd like if you could maybe kick this off, just because I know the Boast team's been talking a bit. What's maybe the main thing that you kind of want to be the overarching takeaway when you're thinking about next steps and how to maximize your access to the benefits?
So along the themes of being intentional and deliberate, being proactive, plan early, that involves your deal team, your tax and legal advisors. It could be just a simple, what does the next 3 years look like? It will optimize your outcomes and minimize your surprises.
I love that. Again, optimize your outcomes and minimize your surprises. There shouldn't be surprises. Obviously, they're going to come up no matter what. It's a crazy world we live in, but you can be intentional on your front and make sure that you're covering your bases to set yourself up for success and then make you more durable in the face of those surprises. So I love the way you frame that, Camellia. Boast team, I'd love to know, again, maybe next 30 days, what are some actionable takeaways? I know we got the bullets here, but what do we mean when we're saying things review current structure with advisors specifically?
Well, I was actually gonna just follow up on what Camellia was saying, because one thing that we often see in the SR&ED process is that SR&ED gets ignored throughout the entire year. And then after the year end, everyone rushes and it's like this 2-week long mad grab of what did we do and trying to pull everything in. And that's when maybe some of the surprises come up, or some of the pieces that really could have moved the needle on SR&ED are not remembered. So again, what Camellia said with being proactive, you can put things in place so that SR&ED doesn't have to be a mad scramble. So I did want to pull that, and so I guess, yeah, I wanted to toss that one out there before. Maybe Carlos, if you want to take on some of the talking points, because I've been talking a lot.
I think, a lot of the folks here in this call, or some of the ones that responded to the poll, indicated that they have claimed before or are claiming, which is great. If there are any folks who have not claimed, one thing I always say is track your work very closely. Make sure you are tracking everything you're doing, even if you don't have a plan yet to claim or ready to claim. Make sure your team is doing so they build that muscle, right? Prepare for a potential claim in the future so you don't have to, as Matt said, go back 12 months in the past and remember what you did on, February 10th from 9 to 5, right? It's easy to do that when you have that muscle exercised. And I think, too, one thing that we do a lot and offer our clients and suggest to them is to think about shred in a strategic way for like the future. Like what would you do if you had another 250K in your budget for next year for FY26? What would you do with that? Would you hire more people? Would you build more product? Would you open a new facility? Like imagine the things that you could do if you knew that that was happening ahead of time. And by that, how would you actually do that? Well, if you have a team currently working and doing the work that is eligible and you've claimed before, you have a good expectations that that's going to happen again. But then if you're working with a provider, and obviously we're one of them, you can learn and be super clear. Hey, if you continue on this path with the team you have today, doing the same work you're doing here, and you complete that by the end of this year, you're going to get very confidently this much back, right? It's not like a guessing game. We have very good tools to determine that and help you make that, identify that very early on so that you can prepare and use that money in advance. We can, seek a bridge finance for the shred program so that you can actually use that money as the year starts, so that by the end of the year, your fiscal year, that money actually comes and you pay them back. There's many ways to do shred. I see a lot of folks kind of using shred as a hopeful thing that's going to come at the end of the year. Maybe if the work is right, maybe we're going to apply, maybe we're going to get some money, maybe we can use that for these things. It is a much different game today with shred, like in terms of preparation, being ready for it, really expecting that to come, not being like a question mark all the time.
I love how you frame that. Before we move on to the Q&A section and off from this slide too, just any other thoughts, like Smythe team, about just like involving your finance and tax advisors proactively? Like, what are some maybe best practices you could do other than just be like, hey, we're doing R&D. This could extend our runway. How do you approach those conversations? Emily, if you have some thoughts, maybe?
Connecting your lawyers and your accountants and making sure they're on the same page. There's, we've run into situations where, the lawyers know about trust agreements that they've set up, and, it fundamentally impacts the outcome, and just being able to communicate directly from the get-go can make things go a lot more smoothly.
I love that. Again, I'm a broken record, but Camellia, be intentional. I think that that's something that we really want to make sure that people leave this webinar understanding. Communicate with all the stakeholders involved. Make it very clear what the value of the shred program is going to be. And also about when we're structuring our business in one way, these are going to be the realities. And lawyers, finance teams, FP&A folks, let's all get on the same page and not be at loggerheads when it's end of year. And then we want to make sure that we are actually getting the numbers to add up for what we're going to be doing going forward. So love how you phrase that. All right. So for the last section, we got about 5 minutes, and for live Q&A, I'm going to turn off the screen share just so that I can get everybody's faces front and center and make sure that I'm addressing them perfectly. So again, going now to the first one, I got a question about CCPC status that I'd love to throw at the Smythe team. So can CCP status be restored after it's lost? Could you talk me through some of those nuances, either Emily or Camellia?
So yes and no. Once you can flip from being a non-CCPC back to being a CCPC, but you can't replace the time that you've lost. Another interesting thing to be aware of is every time you flip from CCPC to non-CCPC or vice versa, you actually have a deemed year end and an additional tax return. And so that can be planning in its own right. If you don't want to pay your accountants for 2 tax returns and you have the ability to align that switch with a year end that's already occurring, that can mean real savings to you.
That's a great point. All right. So next one, how do employee stock option pools affect control calculations? Smythe, I think this might be another one for your team, whether Emily or Camellia want to take this one on.
Well, I think it also depends on like the terms of the stock option agreement and what are they converting into? Are they converting into voting shares or not voting shares? So I think that's also a key component. Sometimes they convert into voting shares, and if you have all these stock option holders down in the US, that often happens, and they've exercised, or even if they haven't exercised, because CCPC status is based on a fully diluted basis, then you could be offside. So again, just be aware of, your cap table on a fully diluted basis, where everyone is. Are they in Canada? Are they not in Canada?
And just to add on to that, the rules are set up that they look at the worst case scenario. And so the question the rules are asking is, hey, what if all of your non-resident exercised their options and none of your Canadians did? Which might not be something that you would think when you're first looking at it. So you're going to want to make sure that on the US exercising only, that you've still maintained that lack of non-resident control.
Okay, and then I got a question specifically for our Boast guys. How do provincial programs interact with federal SR&ED? I think we alluded to this throughout, but Carlos, maybe talk to us a little bit about just what's on offer at the provincial level and how that plays with programs like SR&ED and even provincial versions of SR&ED, because that people often forget is out there.
Yeah, I mean, it varies based on province. I think, Matt, you could give a lot of great details on that. One thing I would say in terms of, you can speak about SR&ED, Matt, if you want, but I'll speak about the Quebec program specifically related to CDAE. Is one of the large e-business tech credit program in Canada today, specifically for Quebec, and it's changing. It's changing in 2026 to include AI as part of it. So companies that are in Quebec, corporate in Quebec, and have businesses there, if you have 6 or more employees, you can leverage some of that work that you've done in terms of R&D, in terms of e-business. There's a long list that we can discuss later if you guys are curious to learn more. Reach out to us. There's another layer of incentive you can get there from CDAE, and that can be complementary to SR&ED. Like you can have a group of employees applying for SR&ED and a group of employees applying for the CDAE incentive. So highly lucrative, $500 million every year the government tries to give out. So highly recommend you guys look into that as well. Matt, do you want to talk about the relationship between federal and provincial across Canada for SR&ED?
Maybe the first thing I'll point out is that most federal or most provincial programs will switch over to being non-refundable, just like the federal program, if you're non-CCPC status or in the future CPC status. So, however, there are some, Alberta being the one that stands out in my head, that will still give some refundable tax credit back. So if you're in Alberta and you're considering CCPC or not CCPC, that's also a consideration to take into account. So from that angle, that's one thing. But in a more generic way of looking at it is, first, the provincial government will pay you or give you the SR&ED back for the employees that are in the province, for the expenditures that are in the province. And then that will be taken out of your expenditures for the federal level. And then the federal will give you the 35% back on what's left over of the expenditures. So I hope that makes sense, but basically it goes provincial first and then federal. And on the provincial, you want to look to have as many employees. If all you're doing would be to maximize SR&ED, you want to look to have as many employees within the same province as you have your office, as where you're paying taxes.
Correct. Man, all right. Folks, as you just heard, we're at time. So there are some more questions, but if there's anything we didn't get to, I'm going to put up one final slide for all of us for a specific offer, just to make sure that folks can get in touch with all the stakeholders here to answer any questions that we left out. So again, Carlos and Camellia were kind enough to give us access to their emails for this specifically. I got to shout out the free SR&ED eligibility assessment followed by a 10% discount, specifically that the Boast team is offering for all attendees who watch this webinar live or who download it after the fact and engage with us on an ongoing basis. So again, it's October 23rd, 2025 here, but this is timely but evergreen. We want to make sure that folks know that these programs aren't going away and that we're going to be your source of truth for making sure that you can capitalize on them. And same goes for our friends at Smythe. They can help you with your FP&A. They can make sure that you're actually avoiding those mistakes before your next raise. So I can't thank everyone here enough. Camellia, Emily, Matt, Carlos, thank you so much. Any final parting words from the team? I'll shoot it over to Camellia maybe.
No, just excited. Thank you for having us. And yeah, get in touch. Happy to chat.
Fantastic. Emily, any parting words?
It's been great working with you guys. I think Smythe and Boast, we've have a lot of complementary knowledge. I've really enjoyed listening to you guys speak as well. So it's been a lot of learning for me.
I love it. Matt, anything you want to say before we sign off?
Well, since you thanked all four of us also thank you for being host and moderator. And I mean, at the end of the day, I'm in the shred business because I want to see innovative companies succeed. I want companies to feel comfortable taking on tech risk because that's what's going to move Canada and the world forward. And I'm a little biased here, but I want to see Canada be leading the world. So this is why, even if you don't go with Boast or whoever, I want you to keep innovating. And I want you to know what's out there for innovating. And yeah, I want to thank Camellia and Emily as well, because they know a lot of stuff. Like, I'm impressed. Just gonna. Anyways, I'll shut up now. Carlos.
No, thank you, man. That's great. I want to thank everybody that took the time to join us and listen to us talk here today, especially the folks from Smythe, my colleague Matt and Paul here. One thing we do really often is to help folks understand the program. So if you have questions for any of us here, for the Boast team to talk about Shred, or for the Smythe team, please reach out. I always like to connect with folks on LinkedIn. Ping me, send me a quick note. Say, I heard your webinar. I'd love to ask you more questions about X. We do that so often, and it's really a way that we collaborate and help folks learn more about Shred. Please do so. Connect with us. We'll be more than happy to discuss anything you want to talk about. We'll book a meeting to answer all your questions. Even if you're already claiming, I'd love to learn what you're working on. So please do so. Don't be a stranger.
I'm just going to echo what Carlos said there. We want to be your active resource for any questions that you have here. And between the Smythe team and what we got going on here at Boast, we can help you cover all those bases. So don't be a stranger. Please reach out to us. Thank you for giving us the full 60 minutes plus some. This was fantastic. Thank you, everybody.
Thanks, everyone.
Bye,
Thank you.
everyone.
Bye-bye.